It's 11:14 on a Sunday night, and you're lying in bed doing the math again. Not because anything went wrong. Nothing went wrong. You're just lying there in the dark, running the exact same numbers you ran last Sunday. And the Sunday before that. The mortgage, the car payment, the student loans, the groceries. You're trying to figure out if this is the month you finally get ahead, or if you're just going to tread water again, like you have been for the last 3 years. You know the answer, but you keep running the math anyway because the alternative is accepting that this is just what adult life feels like now. Meanwhile, your neighbor down the street, who makes the exact same salary you do, woke up last Tuesday and decided to just take the week off. No crisis, no panicked email to his manager. He just didn't feel like going in, so he didn't. And here's the thing. He's not secretly richer than you. He's just not doing that Sunday night math anymore. I spend way too much time thinking about this. Why two people with almost identical situations can end up living completely different lives. If you are tired of feeling house poor, tired of running that midnight math, and want to understand the actual mechanics of wealth, hit that subscribe button. Because today we are going completely off script. We are tearing down the ultimate American sacred cow. We're going to talk about something the personal finance world wildly underexplains. What actually happens to your money, your career, your brain, and your life the moment you realize the standard 30-year mortgage isn't a badge of success. When you're 12 years deep into a 30-year mortgage, you haven't just signed up for a monthly bill. You've signed a 30-year employment contract without realizing it, and you are serving a financial prison sentence you didn't even know you were serving. Let's start with the uncomfortable reality of what affordable actually means right now. You're scrolling through real estate listings, and every single house that doesn't look like it's about to collapse costs $500,000. The kitchen has laminate countertops from 2003, the carpet is beige, there's fake wood paneling in the basement, and the listing agent has the audacity to call it a starter home. The median household income in America right now is around $83,700. Yet the median home price in America is hovering around $415,000. We are asking people making $84,000 to somehow afford homes that cost 5 times their annual income. If that sounds completely insane to you, congratulations, you're paying attention, but everyone keeps telling you it's fine. Your mortgage broker says you're approved, your parents keep asking when you're going to buy, and your real estate agent is smiling and nodding. The problem is that everyone is lying to you about what affordable actually means. There is a massive difference between what the bank will approve you for and what you can actually afford without destroying your life. There's a guideline in personal finance called the 28% rule, which says you shouldn't spend more than 28% of your gross monthly income on housing costs. But the bank will happily approve you as long as your total debt-to-income ratio stays under 43%. Listen to me, the bank's job is not to make sure you are comfortable. The bank's job is to make sure the loan doesn't default immediately. They do not care if you're miserable. They do not care if you can't afford groceries. They just care that you keep making the minimum payment every month for 30 years. That 43% threshold isn't a recommendation for comfortable living. It is the maximum amount of financial stress they think you can handle before you just stop paying entirely. Let me show you exactly how this works with some real numbers. Let's look at a $400,000 house, which is actually below the national median. You scrape together a 10% down payment, which is $40,000. Money that probably took you 5 to 7 years to save. That leaves you with a $360,000 loan at current interest rates of around 6.09%. Your monthly mortgage payment for just principal and interest is about $2,150. But wait, it gets worse. That number doesn't include a single other thing you need to actually live in the building. Add property taxes at a conservative $450 a month. Add homeowners insurance, which has skyrocketed thanks to climate change, for another $300 a month. Because you didn't put 20% down, the bank hits you with private mortgage insurance, or PMI, the fee you pay every month for the crime of not being wealthy enough, adding another $275. Finally, you need a 1% annual maintenance reserve because your water heater will inevitably explode on a Sunday night, which is $333 a month. Your total monthly housing cost is now $3,508. Not $2,150, $3,508. To comfortably afford this using the 28% rule, you need to be making about $150,000 per year. But the bank, using their 43% threshold, would approve you with an income as low as $98,000. There is a $52,000 gap between what the bank says you can afford and what you can actually afford without financial catastrophe. And here is the punchline. Only about 20% of American households make $150,000 or more, which means 80% of American households cannot comfortably afford a $400,000 house under any reasonable financial standard. Let's look at a dual-income household making $160,000 a year. They are solidly in the upper middle class. They buy a $500,000 house. After taxes and a modest 401k contribution, they take home about $9,500 a month. Their actual housing cost is $4,367 a month. They are left with $5,133 for everything else. Subtract 2 car payments at $800, insurance at $250, gas at $300, student loans at $600, health premiums at $400, groceries at $800, and utilities at $450. They are left with just $1,533 for the entire month. They have $1,533 left before clothing, kids' activities, car repairs, medical copays, or the psychological need to occasionally leave the house and pretend they have a life. This household is spending 46% of their take-home pay on housing. They own a house technically, though the bank really owns it for the next 30 years, but they cannot afford to live in it comfortably. Every unexpected expense becomes a crisis. The HVAC dies? That's $5,000 they don't have, so they finance it. We've rebranded this financial desperation as adulting, but the financial cost is only half the burden. The other half is the complete loss of your free time. When you rent and the dishwasher breaks, it's an inconvenience. You send an email to the landlord and go about your day. When you own, it is a weekend-ruining research project. You're watching YouTube tutorials at 11 p.m., making 3 separate trips to the hardware store, or calling 5 different plumbers trying not to get scammed. You have to ask yourself, what is your hourly rate? How much of your peace of mind is being drained by acting as an unpaid, highly stressed property manager for your own house? And here's the part that will absolutely blow your mind. Let's talk about what happens when you stretch that massive loan over 30 years. On a $450,000 mortgage at 6.5%, over 30 years, your total interest paid will be $573,840. Let that sink in for a moment. You will pay more in interest than the house originally cost. The bank is going to collect more from you in pure interest alone than the entire value of the home you bought. It is a beautiful business model, if you're the bank. And the market you're trying to buy in is fundamentally frozen. About 51% of all outstanding U.S. mortgages carry a rate below 4%. If you bought in 2020 or 2021 and locked in a 2.75% rate, you are sitting on a financial instrument that no longer exists. The bank will not recreate it, so people aren't selling. Federal Reserve researchers put the average financial penalty of trading an old mortgage for a new one at over $65,000. $65,000 just to leave. So the rational homeowner stays in the house that's too small, making the supply of homes dry up completely. Because of this, the median age of a first-time buyer has skyrocketed. In the early 1990s, it was 28. Today, the median first-time home buyer is 40 years old. Buying at 40 instead of 30 costs you roughly $150,000 in lost lifetime equity from the decade of appreciation you missed. You are being systematically excluded by numbers that never appear in the cultural signals telling you to buy. Your parents keep reminding you they bought a house at your age. What they don't understand is that they bought a house in a completely different economic universe. In 1980, the median home price was about 3 times the median household income. Today, it's 5 times. Yes, their interest rates were 13 to 18%, but the purchase price was reachable. They could save a down payment in a few years, and they could refinance when rates dropped. You cannot refinance the purchase price. College cost $738 a year back then. They weren't graduating with $40,000 in student loans. This brings us to the most toxic piece of financial advice ever created. The idea that renting is just throwing money away. People love to say that when you rent, you're paying someone else's mortgage, but they conveniently forget the reality of unrecoverable costs in homeownership. When you buy, you are throwing money away on property taxes, homeowners insurance, HOA fees, maintenance, and massive amounts of interest. In the first 5 to 7 years of a 30-year mortgage, you are basically just renting the money from the bank. Very little goes toward the principal. You are paying for a service, exactly like renting. So why do our brains fall for this? Why do we voluntarily chain ourselves to a massive monthly obligation that steals our future wealth? Because we don't understand the psychological warfare happening in our own heads. According to actual peer-reviewed academic research, debt physically impairs your cognitive functioning. A 2019 study published in the Proceedings of the National Academy of Sciences tracked what happened to people when their debts were eliminated. Clinical anxiety symptoms dropped from 78% down to 53%. That is a 25 percentage point reduction in diagnosable anxiety just from closing debt accounts. The participants made better cognitive decisions and became measurably less impulsive. But the most fascinating finding was this. The brain doesn't care about the dollar amount of the relief, it cares about the open tab. For most adults, the 30-year mortgage is the ultimate open tab. It is humming in the background of your life 24/7. It's the refrigerator noise you stopped noticing until it finally shuts off. Every time you want to take a career risk, start a business, or leave a toxic boss, that invisible hand grabs you by the throat and asks, "Can we still make the mortgage payment?" Research literally shows that leveraged homeownership, meaning carrying a big mortgage, significantly reduces entrepreneurship. And it suppresses your lifetime earning potential. Think about the modern job market. If a competitor 2 states over offers you a 35% pay bump, a renter gives their 30-day notice, packs up, and takes the money. The homeowner? They have to calculate realtor fees, prep the house for sale, and pray the market doesn't dip. Those people locked into 2.75% interest rates aren't just trapped in their houses, they are wearing golden handcuffs. They are trapped in their local job markets, literally passing up career advancement because they can't afford to give up their mortgage rate. So what happens when you finally eliminate that mortgage, or when you refuse to buy a house you can't afford and invest the difference? Let's paint a picture of 2 neighbors. Neighbor A bought the $500,000 house and is sweating bullets every time the property tax assessment arrives in the mail. Neighbor B is renting a slightly smaller place down the street for $2,500 less per month than A's total cost of ownership. Neighbor B takes 2 actual vacations a year. Neighbor B sleeps 8 hours a night. Neighbor B's net worth is completely liquid, quietly compounding in the background, untouched by local housing market dips or foundation issues. Neighbor B isn't failing at the American dream. They've outsmarted it. When you free up roughly $2,000 a month in real, deployable money, the math gets wild. If you take that $2,000 and automatically redirect it into a basic S&P 500 index fund earning an 8% historical return in 20 years, it compounds to over $1.17 million. You contributed $480,000 of your own money over those 2 decades. The market handed you nearly $700,000 in pure compound growth. The majority of your eventual wealth came from compound interest, not from working harder. The bank doesn't want to show you that math in their office because their product is the exact thing keeping you from that $1.1 million. If you are already in a mortgage, how do you escape faster? It's not heroic sacrifices, it's math. Switching to bi-weekly payments gives you 13 full payments a year instead of 12. That one change cuts 5 to 6 years off the loan and eliminates over $119,000 in interest. Throwing an extra $1,000 a month at the principal nearly halves the loan term to 17 years. By dropping $2,000 a month in mandatory survival expenses, you instantly lower the amount of money you need to achieve financial independence by $600,000. You haven't earned more money, you just changed what survival costs. Suddenly, you can afford to walk away from a job you hate. You can afford to take a pay cut to do work that actually matters. You can start that contracting business you've been dreaming about, because one bad quarter no longer means the bank seizes your house. The binary choice is yours. You can keep playing a rigged game, acting as a walking subsidy for the banking industry, while you stress over $4,000 a month housing costs just to maintain the illusion of success. Or, you can step out of the matrix. Look at a $500,000 house, run the real numbers, and decide that it's not worth sacrificing your mental health and your ability to build actual wealth. If the math doesn't work, there is no shame in renting and aggressively investing the difference. In fact, right now, renting is cheaper than buying in all 50 of the largest US metros. Real wealth is freedom. not equity you can't access because you're trapped by the very asset that's supposedly making you wealthy. Before you go, I want to hear from you. The housing market looks completely different depending on your zip code. Drop a comment below and let me know where you are watching from, and what the quote-unquote affordable housing market actually looks like in your city. Are you seeing this same madness? And if this video changed the way you look at your money, hit that subscribe button. We are building a community of people who are ignoring the bad advice and building real, tangible wealth. Stop feeding the bank, buy the boring, affordable house, or keep renting while you quietly build a massive portfolio in the background. Because 20 years from now, while everyone else is still financially suffocating to pay for their granite countertops, your future self will thank you for sitting on $1 million index fund with absolute peace of mind.